Eco PLC is a listed company in the food retailing sector and has large stores in all major cities in the country. Eco's broad is considering diversifying by opening holiday traveling shops in all of its stores. At the recent board meeting, the directors discussed how the holiday traveling shop should be appraised. The sales director insisted that Eco's current weighted average cost of capital should be used to evaluate the project as the majority of its operation will still be in food retailing. The financial director disagreed with the existing company's overall work. With the disagreed, right? And then he said the overall, the one that they have called the existing cost of equity does not take into account the systematic risk of the new project. He said that the company's overall work, which reflects all the company's activities, will change as a result of the project acceptance. The board was also concerned about the market reaction to diversification plans. Another board meeting was scheduled at which ECO's advisors would be asked to make a presentation on the project. They work for ECO's advisors and have been asked to prepare information for the presentation. You have established the following. ECO intends to raise the capital required for the project in such a way that as to leave its existing debt equity unchanged. Following the diversification, extract from the four most recent management account are shown below. Now, so let's pick variables. On May, on May 31st, 2017, Eco shares, this is financial statement is also for 2017. Eco ordinary shares has a market value of 2.7 kobo. So market price per share 2.76 kobo. XD and an equity beta of equity of 0.6 for the year ended May. Dividend yield was 4.2%, and the earnings per share EPS was 2.25 kobo. The return on market is RL is 8%, and the risk free is 2%. Now, Eco Ventures at the market value, MPD rather, market price per debentures, MP 108 naira. And then he says that per 100 naira nominal value, per 100 naira nominal value. How many years is it redeemable? 4 years. Okay, so, and then companies operating really already traveling. Now, they are considering into diversifying into holiday travel, right? And then the diversification will affect their cost of equity. Why? Because they will need to consider the beta of assets of the new company, as I said, as I explained in the last class. So the company now, they want to give us a proxy information. Any company that is that we are taking as a case study is called proxy or surrogate. So already traveling have an average beta of, so there's a company is already traveling, its beta of equity is 1.4. An average debt equity of 3:5. And then it is estimated that the project goes ahead, the overall equity beta will be 90%. Overall, 90% of food retailing plus 10% holiday traveling. Then the tax is 20%. Ignoring the taxation, ignore the project, calculate current work. Okay. So look, if you want to check after, just look at the balance sheet. The company sells shares, the company sells redeemable debentures, and also long-term loan. That means the company is financed by three sources of finance, which are debt, equity, and debentures. Yes. So let's go. Now we need to find cost of debt, cost of equity, value of equity. It has debt. We need to find cost of debentures, value of debentures. It has loan. We need to find cost of loan, value of loan, and then we'll calculate our work. So the question has told us that using CAPIM, we can calculate the cost of equity is risk-free plus beta, return on market minus risk-free using CAPIM. So the beta of FO is equal. So the risk-free is 2%. plus beta 0.6 into bracket 8 minus 2. So that gives us 5.6%. So our cost of equity 5.6%. Now, we're going to calculate the value of equity as well. Most time, the value of equity is calculated as market price per share times number of ordinary shares. That is the formula for value of equity. So they've told us that the market price per share is 2.76 times number of ordinary shares. So we take the balance sheet, you will see that the ordinary share capital is 2.3 million in the balance sheet. Can we all see it? Number of ordinary shares is 233 divided by 0.1. That is a 6.431 million. Yeah. So the value of equity is 6.431 million. We are done with equity. So meaning cost of debt. Now, cost of the ventures will use IRR because it is redeemable. So in IRR, we need to get item cash flow.
Cash flow. Discounting factor.
Okay, so here is 0. I think that's going to be what? Market price per bond or per debt. That is, they have told us that the market value of the bond or ventures is 108 per 100 naira. 108 per 100 nominal value. So 108 outflow. We suggest 5% is 108. So 1 to 4 interest. So the interest is calculated as
0.05.
interest is nominal value times the it is the interest rate times nominal value.
Which is 5% times
The interest
100
is the balance is 6% to the over debenture. So we say 6% times 100 gives us 6 naira. Because it is net of tax. Net of tax means that 6 to bracket 1 minus 0.2. That's 4.8 naira is our interest. Net of tax already. That is what I did.
Okay.
1.8.
Okay. You use 5%. Okay.
Exactly. You know,
I
the
use
other you that with is this is what
okay.
it is now. You can see 5% actually.
Okay. Okay. I saw it on top of that. Okay.
No, it's fine. Face value 100. So therefore, it's one factor.
0.822 or 0.823.
This is 2% because
Oh my goodness.
getting the value of debt, which is 2.7%. Make the cost of debt. If are you with that, please? To
Okay.
be
Yeah. Thank you.
2052. So now cost of loan. Cost of loan is interest 1 minus T. So the interest of the loan is 4%. So 4%, 1 minus 0.2. That's 2%. So that is the cost of loan. 3.2%. So the value of loan, you are taking the value from balance sheet 635 Why? Because the money you borrow from bank, you cannot find market value of what you borrow from bank. Market value, cost of capital, cash total. So this is equity, debentures, and loan. So this is 6431. This is 2043, and this is 635. So this is 5.6%, 2.1%, and the last 0.8 is 435.86. So our work is 435.86 over 9118. Over 9118. So we have the 4.7%. 4.7, let's say 4.8%. So that is the existing work of people. So this is the model. The cost of equity is what will change, which will become dividend per share 1 plus G over market price per share plus G. This is what Gordon model will give us. Now the next thing is to find all these variables. So in the question, do we have dividend given? There's no dividend, but they give us dividend yield. So can we have dividend yield from dividend? Yes. Let's find out. And then to calculate this growth, the growth is R times B, where B is retention,
Rate.
and then R is return
Return on investment.
capital employed.
Mm.
The most we call it opening shareholders fund. Okay, so now retention ratio is R retained earnings over part. Now we need to find retained earnings per share. So first let's calculate retention ratio. We know that EPS can be divided into two: retained earnings per share and dividend per share. Do you agree? Because this is also called parts. The profit after tax, they can pay part as dividend, then they plug the money back to balance sheet as retained earnings to fund for other projects or investment at hand. So on that note, we're going to be having let's see 1.05. 1.05 is if you can get DPS, we can get retained earnings per share. So the dividend per share is EPS minus retained earnings. Oh, sorry, we're looking for retained earnings because this is retained earnings over profit after tax. So retained earnings per share is EPS minus dividend. So from dividend yield, dividend yield is 4.2%. Dividend yield means DPS over NPS. So the 4.2% equals DPS we are looking for, NPS 2.76. Or you must multiply. DPS becomes becomes 11.59%. Oh, sorry, 7%. Becomes 0.1159. That's the dividend per share. So since dividend per share is 0.5911, so that means the retained earnings is 0.25 minus 0.11, 0.1341. So now, retention ratio is retained earnings per share, which is um, 0.1341 over profit, which is EPS, earnings per share. We are using PAR, we can also use it as well, 0.25. So we have 0.1341 divided by 0.25. That is 3.64%. So return on shareholders fund, sorry, return on shareholders fund is profit after tax over closing owner's equity, also called shareholders fund, minus retained earnings for the year. Okay. Now, so our part is EPS times number of ordinary shares, which is 0.25 times 2330. This to give us 582.5. Okay. And the closing owner's equity is that one is, when you take the balance sheet, the owner equity here is, class, can you tell me the owner equity in this balance sheet? What's the value of owner equity? Or what's the owner equity?
Okay. The owner's equity should be 5263.
That is closing owner equity. 5263. 5263. So we need to remove the less retained earnings for the year. So retained earnings for the year is 0.1341 times 2330. That should give me 0.1341 times 2330. 312.45. So 312.45. So what I'm going to have is 582.5 over 5263 minus 312.45, 77%. So we have gotten the R, and we have gotten the, this is R, this is B. So next thing is to calculate the growth. The growth is 0.3%. So this is 0.3%. Come back into the formula of a product model, because the equity become, so the cost of equity becomes 0.1159, which is the dividend per share, divided 1 plus 0.06 all over 2.76 plus 0.063. That is the cost of equity. So the cost of equity, which is the new cost of equity, we know more be 5.6, but 10.8%. So since we are still computing work, we'll just come here and put it as 10.8%. So to affect this, to affect this, to affect this, and this, will have become 8.4%. That is the new one. 8.4%. 8.4%. The point is, the cost of equity, yeah, is still risk-free plus beta in the market. So is so so now they want us to extract beta. So why? Because the one that should be accurate in expressing the project must have the risk of the new project. And because of doing that, the first place that we need to inject the beta of equity of the project. So beta of equity. So what are you looking for? What to get beta of assets from the beta of equity? So we now have beta of equity according to the proxy information. Okay, so the beta of equity of the is 0.4 with the debt equity ratio of 0.5. So this one means that this is debt, this is equity. Okay. 1.4 into brackets. Value of equity. Value of equity is 5 over 5 plus 3, 1 minus 0.2 plus 0. Why is everything 0? Because beta of debt is not given to be 0.95. Okay. So we have gotten the beta of asset. The next thing is to extract. So it's to get this to reject into our beta of equity, which is 0.95 plus the debt 2052 plus 635 over 6431 into bracket 0.95 minus 0. This is 1 minus 3. That's 1 minus 0. Now, the Eco PLC debt is two figures. They have ventures and they have loan. So I'm taking these two figures as their value of debt. So this should give us 1.27 cost of equity, which is risk free from beta to bracket return on market minus risk free. So that should give us. So that is all. The power part. Overall equity beta and using the campaign, estimate the overall work of a code that the project goes ahead and comment on the implications of the permanent change work. There's mentioned something on overall when we were reading the question. It says that if the project goes ahead, the overall beta of a code will be 90% for food retailing and 10% of holiday travel. So in this case, the overall beta will be 90% for holiday travel, food retailing plus 10% of holiday travel, 0.9 of 0.6 plus 0.1 of 1.27. Okay, so now the work, what you're now going to do is to now use this thing for beta. So we calculate the capping. You're going to have a risk free, which is 2 plus beta 0.67 and 8 minus 2. This is a 6%. assignments, compute work, complete work.